Interest rates quietly control how your money grows, shrinks, or struggles, yet most people never pay attention to them. Why does saving sometimes feel pointless while loans suddenly become expensive? And how can a small rate change affect your monthly budget, investments, and even job opportunities? In this video, we'll explain interest rates in the simplest way possible. No complex math, no financial jargon. You'll learn how interest rates impact your savings, loans, credit cards, and everyday spending, and why central banks change them in the first place. Today, we will talk about how interest rates affect your money. Simple explanation. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Interest rates. Interest rates are one of the most powerful forces shaping your financial life, yet many people don't fully understand how they work. Simply put, an interest rate is the cost of borrowing money or the reward for saving it. When you borrow money through a loan, credit card, or mortgage, you pay interest to the lender. When you save or invest money in a bank, the bank pays you interest. Interest rates are usually expressed as a percentage and can change over time. Even small changes in interest rates can have a big impact on your monthly payments, savings growth, and overall financial health. Central banks, such as the Federal Reserve or other national banks, set benchmark interest rates to guide the economy. These rates influence how much banks charge borrowers and how much they pay savers. Understanding interest rates helps you make smarter decisions about spending, borrowing, saving, and investing. Whether you are buying a home, using a credit card, or saving for the future, interest rates quietly shape how much money stays in your pocket. 2. Interest rates and borrowing. Interest rates directly affect how expensive it is to borrow money. When interest rates are high, loans become more costly. Monthly payments on mortgages, car loans, and personal loans increase, making borrowing less attractive. On the other hand, when interest rates are low, borrowing becomes cheaper. Lower interest rates reduce monthly payments and encourage people to take loans for homes, education, or businesses. Credit cards are especially sensitive to interest rate changes because they often have variable rates. A small increase can significantly raise the amount of interest you pay over time. High interest rates can trap people in debt, especially if they only make minimum payments. This is why understanding interest rates is crucial before taking on any loan. Borrowing during low-rate periods can save thousands over the life of a loan. Interest rates influence not just whether people borrow, but how much they borrow and how long it takes to pay it back. 3. Interest rates and savings. Interest rates don't just affect borrowers, they also impact savers. When interest rates are high, savings accounts, fixed deposits, and certificates of deposit offer better returns. This means your money grows faster just by sitting in the bank. When rates are low, savings accounts earn very little interest, sometimes not even enough to beat inflation. This discourages saving and pushes people towards spending or investing. For retirees and people living on fixed income, interest rates are especially important because interest earnings may be a major source of income. Higher interest rates reward patience and long-term saving, while lower rates reduce the value of traditional savings. This is why many people search for better options like bonds or investments during low-rate periods. Understanding how interest rates affect savings helps you choose the right place to keep your money and plan for future financial security. 4. Interest rates and inflation. Interest rates and inflation are closely connected. Central banks raise interest rates to control inflation and lower them to stimulate economic growth. When inflation rises, the purchasing power of money falls, meaning your money buys less. By raising interest rates, central banks make borrowing more expensive and encourage saving, which reduces spending and slows inflation. When inflation is low or the economy is weak, central banks lower interest rates to encourage borrowing and spending. This balance is critical for economic stability. If interest rates stay too low for too long, inflation can rise quickly. If rates rise too fast, economic growth can slow down. For individuals, this relationship affects loan costs, savings returns, and living expenses. Understanding this connection helps explain why interest rates change and how those changes affect your daily financial decisions. 5. Impact on home loans and mortgages. Interest rates have a massive impact on home loans and mortgages. A small change in mortgage rates can significantly affect monthly payments and total interest paid over decades. When rates are low, more people can afford homes, increasing demand in the housing market. When rates rise, affordability drops, and fewer people qualify for loans. Adjustable rate mortgages are particularly sensitive to rate changes, as payments can increase unexpectedly. Fixed-rate mortgages offer stability, locking in the same interest rate for years. Choosing the right type of mortgage depends heavily on interest rate trends. Understanding how rates affect housing costs can help buyers time their purchases and avoid financial stress. For homeowners, refinancing during low-rate periods can reduce monthly payments and save money over time. 6. Credit cards and interest rates. Credit cards are one of the most expensive ways to borrow money because they carry high interest rates. When benchmark interest rates rise, credit card rates usually increase as well. This means balances become more expensive to carry from month to month. Many people underestimate how quickly interest adds up on credit cards. Paying only the minimum can keep you in debt for years. High interest rates make credit cards useful for short-term spending but dangerous for long-term debt. Understanding how interest works on credit cards encourages better habits, such as paying balances in full each month. Managing credit wisely becomes even more important when interest rates are high. 7. Interest rates and investments. Interest rates influence investment choices and returns. When rates are low, investors often move money into stocks, real estate, or other higher-risk assets seeking better returns. When rates rise, safer investments like bonds and savings accounts become more attractive. Interest rates also affect company profits. Higher borrowing costs can reduce business expansion and lower stock prices. Lower rates encourage investment and economic growth. Understanding interest rate trends helps investors balance risk and reward. Whether you are a beginner or experienced investor, interest rates play a key role in shaping market behavior and long-term returns. 8. How central banks decide rates. Central banks adjust interest rates based on economic data such as inflation, employment, and growth. Their goal is to maintain price stability and support sustainable growth. Rate decisions are carefully analyzed and often signaled in advance to avoid shocks. Central banks use interest rates as a tool to guide the economy rather than control it completely. Public trust in these institutions is essential for their policies to work. When people believe central banks will control inflation, markets remain stable. Understanding this process helps explain why rate changes happen and what they signal about the economy's health. 9. How interest rates affect daily life. Interest rates quietly influence everyday financial decisions. They affect loan approvals, rent prices, job growth, and even government spending. High rates can slow economic activity, while low rates encourage consumption. These changes impact how much people spend, save, and invest. Interest rates also influence currency values, travel costs, and import prices. Even if you never think about interest rates, they shape the financial environment around you. Being aware of their effects helps you adapt your financial plans and avoid surprises. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.